Welcome to the second part of Chapter 7 recording. So now we're going to look at the concept of liquidity. Liquidity we define as the ease and cost at which an asset can be converted into another asset. Now that other asset is usually cash. So think of it as how easy it is and what kind of fees you have to pay in order to convert something into cash. And here we think about the concept of an asset as well. If I had a whiteboard here, I could write the definition of an asset. An asset is anything you possess that has value, and anything that you possess could be either physical or financial. So a car would be an asset, a house would be an asset, a painting by someone famous would be an asset, a rare coin would be an asset. A mortgage is a financial asset. A bank account is a financial asset. So you can see the difference here between physical assets and financial assets. Now, the way in which we think about this in terms of monetary economics is we think of assets being defined in terms of their degree of liquidity. Their degree of liquidity, in other words, the ease and cost at which you can convert the asset into cash, essentially. So what's the most liquid asset? Well, cash is cash, so you don't need to convert it. So cash is the most liquid asset. Then probably a checking account. Why? Because it's pretty easy to get money out of the checking account. How do you do that? Either by using a debit card or by using a check, or by going to an ATM. Usually there's very little cost associated in doing that, the cost of the check, or the costs of the ATM fee. And your time, of course, is involved there. Then savings accounts, etc. So as you go through these assets, they become less and less liquid. In other words, it becomes more expensive. And think of a CD, for instance. CDs are like time deposits. They're deposits that are made with a financial institution for a period of time. Now, if you decide to cash them in early, you suffer a penalty fee, and it takes time to actually do the transaction. So a CD is not particularly liquid. And obviously the less liquid that they are, the more the interest you're likely to get, because the bank then knows it's got your money for that period of time and it can safely give you more. So demand deposits, that's checking deposits, are very liquid. So converting a demand deposit into cash is easy and inexpensive. On the other hand, if you go to the physical assets, most of the physical assets are really illiquid. They're not liquid at all. If you have some commonality about the assets, then you can get a certain degree of liquidity there. So for instance, an automobile is relatively liquid, but we do have Kelly's Blue Book. You can look up the type of auto. You can try and assess, although people will differ probably, on the condition of the car. Of course, you've got to account for whether it's a lemon or a peach as well, as you know already. So that price can vary quite a bit. So there's less certainty and there's more cost in doing it, because you've got to also go through go into the second-hand market. And anyone who's tried selling a car, that you spend quite a lot of time going to the dealers and thinking about putting it online. And if you put it online or put it into a private ad, then people are going to come and have a look at it, usually bringing along friends or a friendly mechanic or something to check out your car to see if it's trying to assess whether it's a peach or a lemon. When we look at the other physical assets, of course, houses are really not liquid at all. Why? Because a house doesn't just depend on, what's inside. It also depends on the view you have from the house, the location of the house with relation to public transport, the types of people who live round about it, etc. So it's pretty illiquid. And you think about that in terms of the time it takes to sell a house. If suddenly you need money, well, your house is probably the last thing you're going to sell, because it's going to be costly. You've got to pay the real estate fees. real estate agent fees, and also it's going to take quite a lot of time because you've got to find the person who is a good fit for that particular property as well. Now, probably the most illiquid asset is fine art. Fine art is very particular, in terms of, do you like that painting? Would you have that painting hanging in your living room or not? And obviously that's a very personal thing, And although the famous artists that we know, people like Picasso and Miro and Rembrandt and etc., everyone recognizes they are of value. What's interesting is even when you go to an auction house, they'll say the estimated value of this painting is, 5 million, and it can go for 15 million, it can go for 20 million, it could go for 2 million, So the variation is huge, and in that sense, it's very illiquid. In many cases, when you put these things to auction, I've had experience of this myself, you put a holding price on, like you can on eBay, and it doesn't even meet the holding price, so you don't even sell it. And when you do sell it, by the way, the fees that go to the auctioneer are pretty large. I think there's a 20% fee, usually minimum. So sometimes it's up to kind of 30-40% even fee that goes to the auctioneer. So that's liquidity. So one of the purposes of financial banks is to provide liquidity. In other words, it's to provide a way of accessing cash. So that's what this is all getting at here. Secondly, it reduces transaction costs. So when you go to a bank, you deposit your money in the bank. If you put it into a high interest savings account, they turn around and take all that money that people have deposited, and they basically look for good opportunities where they can make money. They can make money by charging to borrow your money, essentially, at a higher interest rate at what they're paying you. Nevertheless, they deserve some of those benefits, some of that interest. Why? Because they've reduced your transaction costs. You don't have to worry about who they're lending to. They're taking on that risk. So there is a price for them taking on that risk if you think about it. Also, just the search costs here in terms of searching for someone suitable to borrow your money. So just think about the hassle it would be if you were a saver and you had to try and place your money with somewhere that would not put it at risk and also would give you a decent return. So obviously banks fulfill that function and do that work for you. Also, there's a mismatch here in terms of the size of the borrowing and the size of the lending. I'm one guy, so I put my money into the bank. Now, I might have even quite a large balance, but if that bank specializes in lending to small businesses, probably a small business is not going to be too interested in little old me. They're going to want a larger amount of money. So you're going to have to put the funds of several depositors together, several people who put their money into that bank together to loan it out to a small business. Of course, with large businesses, you're talking about many hundreds of clients' deposits. The other thing that banks can do is, of course, where my actual money goes is of no interest to me, in the sense that, all I'm interested in is that the overall lending of the bank is not risky. That is, they can make a few risky loans, I guess, but, my money is equally at risk as anyone else's money deposited in that bank. Why? Because presumably the bank is large enough that it's lent to sufficiently large amount of people and businesses that if any one of them doesn't work out, goes bust, then it's not going to affect me. I'm still going to get my money back and everyone else will get their money back. In other words, there's diversification in terms of the lending that the bank has done. The idea of diversification is basically you don't put all your eggs in one basket. And I talked about that earlier in relation to that potash company that I'd invested in, and the fact that some people have put their life savings into that particular company. That is foolish. one of the things that they teach you in basic finance is that you need to be diversified. And incidentally, you need to be diversified not just in terms of the types of businesses that you lend to, but also preferably internationally diversified as well. So when you start to build up a 401k, 401k, that fund should be partially invested in international stocks or international mutual funds. And in fact, when we're looking at pensions, and this is the last bullet point here, we should have not just stocks in terms of mutual funds in a pension, but also bonds, and also hopefully some mutual funds that represent real estate as well, or the individual owns property. So if you own property, then you don't have to worry about putting that into your pension because it's already kind of part of your wealth, if you like. Now this actual chart comes from the Mishkin book. So the banking system as a whole, this is out of date, but the idea hasn't changed and the items on the balance sheet haven't changed. The magnitudes have a little bit, but I'll cover those in a second. So the way in which we do a balance sheet, for those of you who aren't familiar, a balance sheet has to balance. That is, everything that the bank has is owed to someone, including the shareholders, because the shareholders are the owners of the company. So when we look at assets for a bank, we also call those uses of funds. So commercial banks often call their balance sheets uses of, the deployment of funds. They don't call it a balance sheet sometimes, the deployment of funds, because of course if you look at the right hand side, those are the sources of funds. That's where the bank gets its money from. The bank, so let's look at that first. Let's look at the right hand side first. So this is kind of lumping all the banks in the system as of the middle of 2014. Obviously it's substantially out of date now, 6 years out of date, but nevertheless, the items, as I said, haven't changed. So the first thing is checkable deposits. So that's money that's put in checking accounts. Now, non-transaction deposits are the next source. By the way, the distinction between checking and non-checking is kind of blurred a bit now. Nevertheless, the way in which most banks classify it is that if it's a checking account, usually the main purpose of it is to write checks on that account, and there should be a limitless number of checks that you can write. With some of these non-transaction deposit accounts, there might be a limit on the number of transactions you can do. And these are usually known as savings accounts. By the way, some savings accounts do allow for pretty limitless checking as well, in which case they would be under checkable deposits. The distinction, as I said, has become a lot more blurred. So non-transaction deposits, these are taken to be CDs. So these are small denomination time deposits. And the savings deposits. So when I talked about savings accounts, there they are in that category. So that's savings accounts and CDs that are under $100,000. The large denomination time deposits, that's over $100,000, are there as well, 11%. They're mostly businesses that have done those, but some high worth individuals as well. Banks also borrow from other banks and from outside the system as well. Sometimes they borrow from the Federal Reserve, as we're going to see later on. So borrowings are there as well. 20% of liabilities are there as borrowings. Lastly, bank capital. So how do we know what the value is of bank capital? What's the value of all the shares added up? How do we know what the value is of all the shares added up? Well, we can look at the share price on the stock market at that particular date. Probably easier is just to take the total of the assets and minus all the liabilities so far. Because what's left over is called net worth. And so assets there minus the liabilities would come to, if you can see how much it would come to 89. So 100 minus 89, it would give 11. So that gives you what the bank capital or net worth would be. Those two things have to match, net worth and bank capital. Bank capital means the shares. So capital not in the sense of plant, machinery and equipment, but in the sense, the financial sense, coming from the discipline of finance, of the shareholders, the value of the shareholders' shares. Notice that both sides add up to 100 because it's in percent. On the asset side, we have reserves and cash items. So these are funds that the bank has to put aside. Either puts aside in the vault at the back of the bank, or it puts them into an account with the Federal Reserve. Those are called reserves. That's why the Fed gets its name, Federal Reserve, because it carries accounts which relate to the commercial banks. So those are the reserves. Next, the banks also buy US government bonds. So you can see that's the next item under securities. And those are government bonds, so treasuries as we call them, 13%. State and local government and other securities come to 6%. So banks cannot buy corporate bonds. Commercial banks cannot buy corporate bonds. So they can buy other securities. So for instance, they could buy a post office bond, for example. Then loans. Here, the banks can make loans to businesses, and you can see commercial and industrial there. The banks also make loans related to real estate. Those are mortgages, so you can see 25% there. The banks can also do consumer loans, 8%, and they can also loan to other banks, that's 1%. Next, they have other loans, other types of loans. I'm not sure quite what those are. They can be for various different types of purposes, revolving credit, etc., 7%. Other assets, and this includes the buildings that the bank owns for its own business, can come to 9%. And that's their physical capital, of course. So the other assets can be the computers that their staff use, the desks that they have in the office, and of course the buildings that they own. So hopefully that explains the balance sheet of all the commercial banks. What we're going to do now is look at a particular bank and its decision about how much to lend out. Before we do that, though, we need to do some housekeeping in terms of definitions. So first of all, I've already gone over this, but assets equals liabilities plus the net worth, which is equal to the value of the shares, which is equal to bank capital here in that previous table. So the question we want to ask is, how much should the bank lend out and how much should it hold in reserves in order to meet the cash needs of its depositors? The banks, in fact, are told that they need to keep a portion of the deposits aside just in case people want to come and pull out their money, and just in case there's a bank run, a rush on the bank where they have to have money available so that they can meet an unexpected surge in people pulling out their money. That is, the banks are told and have to hold required reserves, and that is as a percentage of their deposits. So reserves, if we look at back to the balance sheet, the reserve amount is made up of what they're required to hold and any excess that they might hold. So I'm moving to that bottom equation there. So total reserves equals required by the Fed, plus any extra that they might want to hold. Typically they hold excess reserves during Christmas and during other times when they know that it's going to be a lot of the general public pulling out money. So summer holidays and Christmas typically. So reserves are the money that is not lent out, so that's currency, plus the vault cash, plus the balance held with the Fed. And as I said, there's a certain amount that's required not to be lent out. Okay, so we're now going to move to a graphic, and here we go. So suppose someone Okay, so these are T's, by the way. T's are the other name that accountants use for balance sheets. So here you can see this particular bank has assets and liabilities. Let's start off with the top. So if there's a deposit into this bank, then its checkable deposits on the right hand side go up by 100. Of course, that means it's got money in the vault at the back of 100. Say it's 100 in cash. That is then deposited with the Fed, but it counts in any case as reserves even if it's in the vault at the back. So its reserves go up by 100. Now let's say that someone came instead with of wanting to add 100 in cash, but said, okay, I'm going to deposit a check, which is the usual thing that people do. So checkable deposits once again go up by 100, but before reserves go up by 100, you would have the cash items in process of collection going up by 100. In other words, the bank is busy basically going back to the writer of that check and finding out who they banked with and connecting with that bank and ensuring that that individual's account goes down by $100. So that's what's going on there. Okay, so before we get to this next one, day two with Anchor Bank. So let's assume that some money comes into this Anchor Bank. If the level of demand deposits in the system increases, so here you have money coming in, flowing into the bank, as we've shown how that works, then there's going to be an increase in the money supply. There's an increase in demand deposits, and of course if it's cash, it's going into the bank, but there's also, that means that deposits have gone up by 100 as well. So there's an increase there in the money supply, because the money supply is equal to cash plus deposits, if you recall. This is exactly what happens when a bank writes a loan and creates a new demand deposit for the loan customer as well. So when the bank has money coming in, of course, it can use that money and lend it out. Lending it out means it's going to end up in someone's hands and in someone's account. And that means that because the money supply equals cash plus deposits, deposits have gone up by that amount, therefore money supply has gone up by that amount. This, it turns out, is how the modern banking system works and how it creates money. So the banks also serve the function of being money creation mechanisms as well. So the important thing to remember here is that a large portion of our money supply is created through the banking system. So when banks lend money, that money is created, and it's through the banking system that the money supply is increased or decreased. So the banks play a pivotal role here in the creation and reduction of the money supply. We're going to see how that works here. So let's assume that money came into the First National Bank, and assume that there's a reserve ratio of 10%. So money's coming, we can see that there. It's $100. So First National Bank now has to keep 10% of that $100 aside. So it does. It takes the $100, it takes $10 of that 100, that's 10%, and keeps it as required reserves, so as reserves. The rest is excess reserves. So unless it's got a good reason to hold those excess reserves, it's likely probably to want to make money out of them. So it will loan them out. So here you can see what happens on the next T, so that's on the right hand side, T, right hand side balance sheet. Here we've changed excess reserves at plus 90 to loans at plus 90. So that means that the 100 that came in has created a loan of 90. Now if that loan is to an existing customer with First National Bank, then of course their checking deposits goes up by 90 as well, and they can draw that 90 out. Okay, so that 90 is then into the new money in a way that's into the money supply. So if this lending is a 30-year mortgage, for example, the bank borrows short. In other words, it's borrowing by a checking deposit coming in and lends long because it's funded a 30-year mortgage. So that loan might be to an existing customer for a mortgage, for example. So that's gone into that, and therefore, basically there's an increase in the money supply there. How do we account for this increase in the money supply though? So if money's lent out, it's redeposited in another bank perhaps, and then some of that deposit lent out again. So let's take that mortgage idea. What happens there is that, of course, an existing customer gets a mortgage, and that money is then paid over to the homeowner. The homeowner then takes that check that's come from the bank and deposits it into their bank. And that money is therefore in their bank and then can be lent out again by their bank. And that, etc., is going to cascade through the financial system, increasing the money supply, as M1, money supply measure, we did right at the beginning of the course, is equal to currency plus deposits. What we can do, assuming we don't have any excess reserves, why? Because that messes things up a little bit in our equation, the way this works, is to then basically look at how the money supply changes. And the money supply changes in terms of how the deposits in the system change. And that can be calculated, I'm not going to derive it, but you can derive it if you want, as the initial deposit multiplied by 1 over the required reserve ratio. So of course, increased lending also means that supply of loanable funds increases. So if supply of loanable funds increases, what does that do? Well, it's going to push interest rates. I'll leave you there to work that one out. If you've forgotten demand and supply for loanable funds, it's probably a good time to review it. Okay, so that's really given you the basic engineering that goes on in terms of the bank's role in money supply creation and reduction. So banks can be subject to these bank runs, of course, and I talked about this earlier. So when all of the depositors of a bank want their money back at once, they all run to the bank. It's called a bank run. How do you make people, though, believe that the banking system, therefore, is safe, and that rumours of incompetence or that a bank is already bankrupt doesn't result in panic by the depositors and a bank run? Well, one way to do it is the architecture of the banking system, financial system. In other words, to make sure that you have adequate deposits there, reserves there, I should say, reserves. And another way is to actually insure those deposits. We have both. We have both reserve requirements, which should give depositors some kind of comfort that at least the 10% of all the deposits are sitting there waiting to be withdrawn if necessary. So there's a kind of a cushion there. And also, even if the bank does go bankrupt, they've got deposit insurance, so they should get their money back in time. You can also have a situation which we had incidentally back in 2009 when banks just suddenly refuse to lend. They don't want to take the risk of lending to anyone. That is called a credit crunch. So when private borrowers find borrowing from banks difficult. Incidentally, this happened, as I said, in 2009. I remember going and shopping for a car in that year, and I remember going into a car dealership and saying, well, can you, I want this car, can you do the financing for it? And their response was, well, officially yes, but no one's lending right now. Sorry, you would have to pay for it in cash. So you can imagine in a downturn, if you do get a credit crunch, then all sorts of industries like the automotive industry, anywhere that requires most people to take a loan in order to purchase, is going to be absolutely crushed. So banks, often do this to protect their balance sheets because they don't want to lend to risky prospects at all. And it didn't matter who you were back in 2009. The banks were just not interested in lending anything. So it became a real problem because, of course, the Fed views the banks as one route to stimulate the economy, to pump more money into the economy through their role in terms of this deposit multiplier process. Now, if they're not willing to lend out anything, it doesn't matter how much money you give the banks, none of it will get lent out. In fact, that's exactly what happened in 2009 as well. The banks, there was all these facilities and the Fed set up for the banks to borrow, to lend out money, and the banks weren't interested. You know, the other thing is that banks, although you might hate them, do fulfill a very important role in our economy. Because without banks, it's very difficult to get loans. It's much easier now because there are these online companies that will give loans, etc. And banking itself is changing, but still, when you look at most loans, there's usually a bank behind them somewhere. So, if there are no banks, lending does not take place, the money supply does not increase, and most important, the level of economic activity doesn't increase. So without banks, it would be very difficult to conduct a monetary policy, that is to change the level of the money supply, and the Fed relies on the commercial banks to be the means whereby the Fed can change the level of the money supply. If there's a lack of economic activity, unemployment may increase and businesses may fail. In short, the entire economic system may stagnate. So, just to note, the simple deposit multiplier is a useful tool, but what are the problems here? Well, it's a very simple setup, a very simple framework, but they are unrealistic, and they're unrealistic because we've assumed, if you remember, zero excess reserves. In fact, banks, particularly during the Great Recession, held huge excess reserves, and they've continued to hold excess reserves, actually. And they still hold excess reserves now. Now, before the Great Recession, 2007 to 2009, banks held very small, hardly non-existent excess reserves. Non-bank public holding cash, when, of course, in our little model here to get the simple deposit multiplier, we assume that everything that's lent out by the banks comes back to the bank as a deposit somehow. Well, that ignores the fact that some of the money may not come back to the banks in this kind of cascading process. Some of it may not. It may get hoarded by the public. So a large problem in cash holdings means that the deposit multiplier is going to fall, of course, because it means, when we look at this cascading, the bank lends out money. All of that money doesn't come back into the banking system. The more that's hoarded, the less is multiplied up. Therefore, the less the money supply will increase by. So here's a summary of what we talked about. It's quite a long chapter, quite a lot of meat in here. So thank you.